First time in almost 6 years, the Reserve Bank's preferred measure of inflation has risen within its target band, but money markets today are pushing up interest rates, betting the RBA will be forced to raise rates sooner than its current targets. Ross Greenwood has this story.
Inflation, of course, is the rate at which prices are rising. The higher inflation goes, the greater the likelihood that eventually interest rates must rise to quell the increasing cost of living. Today's headline inflation rate is 3%. For the past quarter, it's ahead by 0.8 of 1%. In the past year, the prices rising fastest include transport. That's mainly petrol. It's up by 10.4%. Other notable rises include furnishings and household equipment, up by 6%, health, up 4.9%, alcohol and tobacco, up by 4.4%. But oil and petrol, they're the key. The Australian Institute of Petroleum shows this time last year, average petrol prices around the country were 116.8 cents a litre. In the past week, petrol rose to 169.5 cents a litre, a record high and 45% higher than they were just a year ago. Now, the Reserve Bank's preferred measure of inflation is called the trimmed mean. What this does is it removes the biggest and smallest price falls. The RBA's mandate of operation says this rate should remain within a band of 2 to 3%. But for almost 6 years, until today, this measure of inflation remained below that band. In other words, below 2%. So, in today's release, the trim mean ticked up to 2.1% with those higher fuel prices. The result is that money market traders think the Reserve Bank will be forced to raise interest rates sooner than its stated aim of 2023. The key long-term interest rate, the 10-year government bond rate, has increased from 1.04% to 1.84% in just over 2 months. And today, with the higher trim mean, interest rates shot up on money markets, anticipating a Reserve Bank move.